From Las Vegas, Nevada, the entertainment capital of the world, I'm David Gabbry, and this is the Vegas Faces podcast, where we talk with Las Vegas locals about what it's really like to live in the City of Lights. Whether you're living in Vegas, moving to Vegas, or just visiting Vegas and looking for new adventures, together let's discover the hidden gems that make Sin City the most visited place on earth. What's up, everybody? Welcome back to another episode of Vegas Faces, where we talk everything Vegas and what it's like to live in the entertainment capital of the world. I'm David Gavrey. I'm a Las Vegas realtor with Realty One Group Summerlin. Shout out to producer Paul behind the scenes, making us all look good. This week's topic is rates. Is housing about to be more affordable? With us today are Stephen Noel of United Mortgage Corp. They were on Vegas Faces episode 21, titled Mortgages and Martinis, where we sip martinis and talk rates. Here we are a year later to talk about the importance of rates, how it affects buyers, how it affects sellers, and the overall housing environment. Let's get right into it. Stephen and Noel, welcome to Vegas Faces.
Good to be back, David.
Yeah, thanks for having us back. Really looking forward and excited for what you've got in store this evening.
Well, I'm happy to talk to you guys. You guys are the experts on this. So I really just wanted to get into more just about rates in general. And before we get to that, let's start with the current environment. Let's start with the big announcement from Jerome Powell at the Federal Reserve, how we think rates are going to go for the rest of this year and next year, and how we think it'll affect housing for buyers and sellers.
Yeah. So Jerome Powell came out and I quote, he said, "The time is now," meaning that they're going to make the Fed funds rate less restrictive, which basically means cutting the interest rates. He said that the upside risk to inflation is now behind us or has diminished. However, the downside risk of unemployment has increased. So that's giving them the signal to start cutting rates, be a little bit less restrictive with the economy overall, which should bring down interest rates. The federal funds rate right now is 5.25 to 5.5. So you can usually add on about 100, 150 basis points to figure out where the average interest rate is right now. So the average rates are sitting at around 6.5, 6.75. If the odds makers are correct, the Fed funds rate goes down to 3.125%, and that would put mortgage rates at about 4.25 to 4.5 by the end of 2025.
Wow. Before people get excited, because I feel like that makes people excited, right? To go from 8% to 4%. But what exactly goes into the process of cutting rates? Is it as simple as someone just pushes a button, pulls a lever? You know what I mean? What is it? What does it look like? Is it over a long period of time, a couple of years? What exactly does the process look like? Does that mean that they have to print money again? Isn't the last time that they lowered rates, wasn't it during COVID? And then also lastly, historically, doesn't it mean that when they lower the rates, that's because of something that's wrong and that they have to fix that?
Well, if you ask the people of the Federal Reserve, the reason to cut rates and decrease rates is to be more restrictive with the economic policy or less restrictive with the economic policy. What I mean by that is when they started increasing rates aggressively over the last year and a half, 2 years, what they were trying to do was slow the pace of a very hot economy. Remember when we were all overbidding on houses and waiving appraisals and everything like that? They felt that there was too many dollars in the system. So in order to remedy that, they start to raise the interest rates. But the rates didn't go from 3.5% to 8% overnight. It's a gradual increase as they raise rates over time. The same is true in the opposite effect. It's not going to have an immediate impact in mortgage rates or credit card rates or anything else for that matter. What it's doing is it's signaling that they're trying to be less restrictive, put more dollars back into the economy, and they're going to do it gradually over time. So, give or take a year and a half or so. And to your point, right, we hear rate cuts and of course we all get excited and we're ready to celebrate, but 150 basis point rate cut is not going to do anything dramatically, but it's really signaling that we're headed in the right direction.
Should we be scared about the money printing given inflation and everything like that?
Noel, do you want to jump in there? I've been talking a lot.
No, but um, no, Stephen, can you answer this one, please?
Yeah, yeah, certainly, right. Well, the first point that Jerome Powell made, he said that the upside risk to inflation has diminished. So, in theory, the inflation part should be behind us, right? Now, usually when they start to cut interest rates, it's a sign of a recession, which can be scary, right? The word recession sounds like it's meaning high unemployment and just an overall tough economy. But for us in the housing industry, house prices have gone up seven of the last nine recessions that we were in, and the housing market performs well. Typically in recessions because I believe it makes houses a little bit more affordable. The interest rates will come down. And it's usually a good time for the people who are savers, if you will, or good with managing their money. A lot of times they're on the sidelines. They're waiting for those recessionary indicators to hit because that's usually a good time for them to pick up a house at either a lower price or a lower interest rate.
I want to get more into how rates in general, no matter what market you're in, no matter what the housing environment currently looks like, how does rates, how does it influence the buyers? How does it influence the sellers? How does it influence the equity on people's homes who already own homes?
In the past, interest rates and price increases didn't go together the same way that they have been. This is kind of an anomaly. Typically, when interest rates would go up, the value of houses would go down, but not this time around. And I think the reason that you're seeing that is because there is still very limited supply, and it's very hard to build our way out of it. Meaning building new houses at the same pace that household creations are being made. Every year there's a new group of people who come into that age where they're ready to buy a home. And then, you have a lot of people coming here from other countries. They need a place to live. They're going to be home buyers, right? So the demand keeps growing and the supply just doesn't come to the market. So that's kind of where we saw house prices and interest rates increasing in tandem, which again is pretty unusual. But to answer your question, when rates do go up, you have an affordability problem with a house, right? A lot of people have chosen not to purchase a home because they thought to themselves that with the rates being where they are, they wouldn't be able to sustain the mortgage payment plus the other aspects of their lives that they have. So to that point, I think getting a little bit of relief on the interest rates will make housing a little bit more affordable. And I think that behind that, there have been a lot of people who are sitting in low interest rates that are homeowners currently that just absolutely refuse to make a move because they didn't want to give up their low interest rate. So those houses aren't coming to the supply. But if they see an opportunity to either upgrade their home or downsize or make that move that they've been wanting to, I think they can justify it at a lower rate, and then that will bring more supply to the market, and that should be good for inventory and the overall supply and demand. It would be great to be in a normal supply and demand period for a little bit.
What do you think about the whole myth that, oh, once rates drop, therefore the demand is going to go up and the housing prices are going to skyrocket like they did in 2020 with lots of multiple offers and things like that? Like how do we keep that from happening with all these people that have been sitting on the sidelines waiting for rates to drop, and then once they finally do drop, how do we know it's not going to be a frenzy out there?
Yeah, I think that absolutely when mortgage rates do drop, it's going to push up that demand or people actively out there searching to buy a home. And usually, when that happens, we get things like less concessions or incentives, from sellers. Willing to help out a buyer. That's a risk when rates drop. Also, as well, with so many people now becoming approvable by default, it just pushes them house prices up, especially in an area with low inventory. So it's possible in an area, or it's very likely in an area like Las Vegas, that we could see similar things happening, and maybe not to the extent that we saw it back in the COVID days, where people was buying out of state by simply looking at a picture on Zillow, or with the realtor walking around a house with their iPhone, and trying to sell a home that way. I don't think it's going to be as crazy as that, but we're definitely going to witness like an increased demand for people out there looking for homes.
For buyers specifically, like what role do interest rates play in determining the length and type of mortgage that a buyer should consider?
David, here's what I've noticed, and it's kind of interesting, I think, and Noel could attest. We started going through clients that we've closed over the last couple of years, and some of them had interest rates with eights in front of them, you know. But here we are, fast forward 18 months, and the people that have the 8% interest rate are all of a sudden looking at an opportunity to refinance and lower their payment and stay in the house and make their mortgage payment a bit more affordable. But at the same time, in a year and a half, if the national average is give or take 6%, maybe a little bit more here in Las Vegas, 8% appreciation, they could be up realistically 10% from where they bought the house. So, that's $50,000 on a $500,000 house. And yeah, they had the high interest rate and they stuck it out and they made the payments on time, but they're about to be rewarded because they've got a house that's worth $50,000, $60,000 more, and their payment's about to come down. That's why I really try to tell people don't pay so much attention to the interest rate. It's not your forever interest rate. You can change it if market conditions improve. You can change with those market conditions. Reminds me of that old ancient Chinese proverb: "The best time to buy a house was 20 years ago. The next best time is right now." Noel and I were talking about it yesterday. Imagine you purchased a house 25 years ago. What was that, 1999 in Las Vegas? What do you think you bought that house for? 150,
Yeah.
$200,000, right? And the 25 years is going to go by whether you like it or not.
Right.
So right, it stands to reason that a house that sold back then for 150,000, that's now 600,000 in 2050, is the same house that you bought for $600,000 going to be worth 2.1 million, million eight?
Right.
Logically speaking, yes, right? So, buying a house shouldn't be about the interest rate or who's going to be the next president. None of those things really matter. What matters is, taking that appreciation over time. It's a long-term investment and it's a wealth builder. And if you stick it out, at least historically speaking, you've made out well. If you look at house prices going back even 60 years, right? They've continuously gone up. There's been a couple of times where they've pulled back a little bit, but by and large, it's been a very safe play that's helped many people build wealth who otherwise might not have had that opportunity.
Can one of you guys go into the refinance process for someone who maybe they're a first time homeowner, they just bought a house a few years ago at a much higher rate. Maybe they feel like, okay, in a lower rate environment, maybe I can refinance, but what is the process there? What does that even look like? How do you even do that?
I mean, a refinance loan is a fantastic tool. Um, First off, if you have a government-backed loan, such as an FHA or a VA, there's what's called a streamline option that's available to you. And it's called a streamline because it's a very streamlined process. Typically, you don't have to show any type of bank statements, pay stubs, income verification. Pretty much the barrier to entry with one of those is that you've made your mortgage payments on time consistently. There's not even an appraisal, right? That's on these government-backed type of loans. And what you're able to do is just take advantage of the lower rates. In that type of situation, you can't pull any money out to do any type of debt consolidation or home improvement, but you can lower your interest rate significantly. And there's no limit of how many times that you can do it. So if rates continue to go down, you could continue to streamline that loan down as low as the rates will allow you to go. Of course, there always has to be a baked in benefit to you to do it, but as long as there is, you can do that. And with the non-government loans, like conventional type mortgages, a refinance is a little bit more. There's a few more details to it, but it's a much simpler transaction than doing the purchase, and it's a lot less expensive. There are a lot of costs that go into buying a house that don't exist when you refinance a loan, and most people choose to finance the closing cost into the loan, which is something that you're able to do when you're refinancing. You can't do that when you're buying a house, right? You have your down payment, your closing costs, and you can't finance the closing costs. But in a refinance situation, typically, most people will finance the closing cost. And if there's an out of pocket expense, it's usually limited to like the cost for the appraisal, about $500 or $600. The other thing that's pretty cool about a refinance is that it typically works out in a way where you don't end up having a mortgage payment that's due for a couple of months, right? I don't want to set the wrong expectation. There's no deferment and there's no skipping of any months. You're not skipping anything. But there could be about a 60-day window in which you don't have a mortgage payment due. So, I mean, there's a lot that you can do with that. It could offset the total closing costs or a portion of the closing cost, or it could just give somebody who might be struggling right now just a little bit of breathing room, right? You know, a couple of months off from the mortgage payment with the way that things are going. I know credit card debt is at an all-time high right now, and prices of everything are pretty high. So it might just be a nice little pause without harming or endangering their credit. Just not having that mortgage payment due for a couple of months. It's a nice little perk built into the refinances.
Are there any misconceptions that buyers have about interest rates when purchasing a home?
Some of the misconceptions that I have seen, especially this year, is that an advertised rate, that's what the customer is going to get. Really, sometimes people do not they don't read the smaller print there as well. What it takes to get that interest rate. Is it a certain credit score? Does your credit score have to be over a certain number? Instance, for instance, something like that. How many points might it cost to get the rate down, or is it both of them combined, which could get you that possible rate? So I've seen that a lot more, this year. Usually a
Yeah,
misconception that I've seen. Yeah.
yeah, that's a good point, and I'll even add on to that. Kind of going back in retrospect, there were so many people who wanted to buy down their interest rate and pay extra money up front. And you know, I think the common narrative amongst the home buyers, get the lowest possible rate. But again, fast forward a year and a half, a lot of people are going to end up refinancing their loan before they reach a break even point with the extra money that they paid at closing when they bought their house. So again, right, that's where I'm going with, don't always look at the lowest possible rate. That might not necessarily be the best option, right? There's
Like
a
there's
lot
more
more that goes into it. Yeah.
like there's more factors to it. Like don't just isolate the rates. Like there's more to it than just the rates. Is what it sounds like you're saying.
Yeah, absolutely. And people get tunnel vision. I think low rate, low rate, low rate. They want the lowest rate. Even if it's at their own detriment by paying extra money up front and other things like that. And we're starting to see that now, where people are going to end up refinancing before they got the full value out of the extra money that they paid to get this lower rate that they were after. At the beginning of the purchase transaction.
Noel, are you seeing more activity, like or less activity? Same. Like what are you seeing in terms of people that are coming to you guys' office, and what are some of the things that they like to discuss? nowadays in a low rate environment that we're headed towards?
I think right now, like Stephen just mentioned, over the past couple of years, the people that have purchased, and because of the big media hype that they're seeing with interest rates trending down, there's a lot more activity for us as originators, originating mortgages as well, because over the past 18 months to 2 years, we really haven't had a great opportunity to use the refinancing tool, that we have. So there's definitely a lot more activity, a lot more people inquiring. Is now the right time to to which me and Stephen have kind of started our own strategy now, where we're aware that the rates are going to continue trending down. So let's call these people now and let's see what number is most advantageous for them, or what kind of savings do they want to make on their monthly payment. And we're creating files, so we have these applications, these refinance applications, just ready to go. When it gets to that certain strike rate where people are going to see the savings that they want, or see that interest rate number that they want. So we can just jump on it, lock it in, and get the file processed and started.
Yeah. And it's been very well received, right? When we reach out to past clients and say, hey, there might be an opportunity here. They can't wait.
Yeah. Yeah.
And rates aren't quite there for everybody just yet, but there's definitely a lot of pent up demand when it comes to lowering your payment and saving money, obviously.
Yeah, it'll definitely be interesting to see, just because of the whole, like, the rate lock, and how, I mean, you talk to people that are like, oh, I'm in the 2% range for my rate. Like, why would I leave? Why would I ever leave? And so
Well,
it'll
yeah, if you're in the 2% range, that means you probably bought your house close to 4 years ago at this point. So you're up massively, right? So if you want to make that move up or move down, I'm sure it's going to be a little bittersweet to separate yourself from that 2% rate. But when you have to, just like we said before, there's more to it than just the rate. There's how much have you gained in value over these last 4 years. It's astronomical, I'm sure, especially what we've gone through. And I think that softens the blow for taking a higher rate when you're positive 60% at that point.
Guys, I would say, to wrap it up, the last question I really want to get both of you guys' input on is, do we think housing is going to become more affordable?
Unless there's so many more houses that come onto the market where we don't have, the people out there on the buy side, then I guess it's all dependent on the area as well. And what inventory looks like. With an area with with a huge influx of people moving to it, because the town or the city is expanding, or they're seeing a lot of growth, then the opportunity for house prices decreasing when you have a lot of business moving there. Let's use Vegas for example. We've got so many more casinos opening. It's now in the media or in the works that Warner Brothers is coming here. There's so much opportunity, and then we have this high speed train that's going to connect us to LA as well. So Vegas is going to be in turn an extension of LA, because you're able to get a super speed bullet train all the way there. So when you connect in places like this, or growing them so much, will we see a decrease in house prices? I mean, personally, I would say unlikely.
Yeah, I agree with you 100%. David asked, is it going to become more affordable? And everything
Steven,
that
let me pause you real quick,
what's,
because
yeah,
I and here's what's funny. Vegas is unlike any other city in the country. So even if prices do become more affordable in other cities elsewhere, what Noel was just saying about the what Vegas is constantly building and ramping up, And again, I didn't mean to interrupt you, but I feel
No, no.
like it's hard to speak on uh, the overall housing market in the country versus the Vegas housing market. I think it's like two completely different comparisons. But what are your thoughts?
Yeah, no, I agree with that sentiment 100%. And to both of your guys' point, I wouldn't call it necessarily more affordable. I just hope that we go into a more normal supply and demand type of market, where there's 4 to 6 months of inventory that's available. And we've gone through a point where there was no inventory, and there hasn't been a lot of inventory, but still, we haven't really seen a, well, quote unquote, normal market. And I'm hoping that with the decreasing of the interest rates and the other economic factors, that we just get to a more what's been considered normal, healthy market, where it's not too heavily weighted on the buyer's side or the seller side for that matter.
Yeah, let's just see a normal market. Let's not see any crazy making
Yeah,
70 offers on a house that has
right.
unfinished drywall and there's no inspection and no appraisal and we're waiving everything and hope it all works out.
Yeah, it's been 4 years and normal hasn't been mentioned in the conversation, right? So it would be nice to go back to a more normal environment. I can go for that.
Hopefully we see like a slow, steady, keep it normal, and hopefully as far as rates go, I really like what you said about just don't just focus on rates. I do think that it has been like this constant. You wake up every day. Oh, what are the rates today? Oh, are they going down? Are they going up? And it has really, whether we like it or not, has heavily influenced the way people have been buying and selling houses.
Most definitely.
Yeah, no, I just wanted to add something to that about normalcy and interest rates. I mean, if we look historically, interest rates over the past 50 years, then the average is, mid to high sevens for an interest rate. So is it the interest rate's fault, or is it everything else currently or economically that's affecting that? I just wanted to add that one to the end, really,
Yeah, that's great.
because it is kind of where we are, where what we've been witnessing and what we've been seeing actually with interest rates over a 50-year period is normal. It's not super high. We're not in the, when we average it out, it's been in the sevens more than it hasn't, right, Stephen? So
Yeah, yeah, absolutely.
I know,
it,
but the one argument to that is the price. We didn't have
yeah,
these kinds of prices with
yeah.
to go along with those rates. And yes, I know real estate appreciates, and I think that's been the latest, I guess, complaints from buyers is that yeah, I know we've had rates that were high in the past, but we didn't have prices this high to go along with those rates. But I guess again, that's just how it goes with when something like this appreciates over time.
Yeah, 100%. And I think we're past the yeah, I was mentioning this to somebody the other day. The low rates are so far removed, going back a couple of years, that a person who's coming onto the market right now who wants to buy a house, who maybe buying a house in 2021 or 2020 wasn't even in their zone, they're not thinking about what rates were in 2020. It's meaningless to them. They weren't thinking about buying a house. So they're in the market now. Oh, okay, rates, whatever, mid sixes, low sevens. They just accept it, right? So there's been that part too, right? It takes some time for those low rates, and everybody wants them to come back. And you have those people who are like, "Oh, rates are so high right now," but that's kind of a thing of the past. And I think the people who are coming onto the market now are just like, "Okay, it is what it is. So let's buy
Yeah,
this house." Hmm.
and that's the thing too, right? I mean, life events dictate buying and selling a house. Like
Absolutely.
you can wait all you want, but eventually, you get married, you start a family, you have certain needs. People tend to, like you were saying earlier, okay, even if we buy it at a higher rate, we can always refinance. And so it's either that or just sit around and rent. But I mean, that's a whole episode in itself as to why that. I mean, renting for a short term, I get that, but for a long term, it'll just really just wipe out your net worth. Like you really just won't have anything in savings after giving up with the way the rent prices are going right now. So, um, I'm of the opinion of short term is great for renting, but long term can just really be detrimental to building your wealth.
Yeah, absolutely. You know, the thing about inflation is that it harms the people who don't own assets the most, right? You know, as we all sit here, we own houses, we have investments, other things like that. With all of this inflation that's gone on, those things have gone up,
Yeah.
right? It's when you don't own anything or you have no assets is when inflation will crush you, you know. So it's good to own something. When you own things with the inflation, the value will go up, you know. So inflation will be back, right? If you look historically, it's like a bad villain in a horror movie, right? It comes back. It will be back again. So yeah, so prepare yourself, buy some assets, hold some things that will also go up the next time inflation starts to rear its ugly head back, and your asset will go up in value too.
Yeah. I
Just
like
not a
that.
car.
Say that again, Noel.
Just not a car.
Right.
Yeah. Right. Guys, it's been fun. Thanks so much for being here.
Awesome, David.
Appreciate
Thank you, man.
appreciate the wisdom. Always appreciate the knowledge. And thank you again for being one of the Vegas faces.
Yeah,
Thanks,
thank you
David.
so much for having us back again, David. You're awesome at this. You're a natural. So it's nice to be invited back.
Appreciate you guys. Thanks again.
Cheers,
You guys
guys.
get a
Be
good,
good.
have a good night. Thank you for subscribing to Vegas Faces on Apple Podcasts, Spotify, and YouTube. Find us on Instagram, Facebook, Twitter, and TikTok under the name Gavri Group. That's Gavri Group. Thanks, everybody. See you at the next episode.